Good evening, ladies and gentlemen. This is the final video cast for the end of the week report, and I'm going to go over what I consider to be the reasons behind this type of correction, retracement that I believe is about to occur. So, before I go any further, the simple question that everyone should ask is, well, how do I make money off this? These are great forecasts, and how do you, well, the best way you make money off it, and you make substantial amounts of money off it, which I've shown hundreds of times, is to basically use the tactical S&P puts, SPY puts, RUT puts, IWM puts, and vice versa if these things are moving in the other direction. And let's say we break above the consolidation channel over 2091, which translates into 2095 or 2096 on the S&P 500, in which case you obviously, you're talking about the calls. But we're talking about retracements here, so we're talking about the puts, right? So those are the simplest way to do it. Now those are two, on a 100-point drop on the Dow Jones Industrial Average, right? Which comes to about a 30-point drop or so. I'm sorry, about a 20-point drop or so on the S&P 500, or maybe a little bit less. You can double your money. I mean, what more can you ask for? We had puts on Thursday, which went from 3 to 18. We staggered the sell along the way, which the next day went to almost 32 because the market pulled back. So, I mean, who shows you this type of phenomenal ROI, return on investment? So you got to manage your trade accordingly. Can't bail out on the quick, on the first 1 point move. Because if you know what's happening in the background, it gives you the confidence to stay with the trade. I've said that about the long side, I say about the short side. The difficulty arises, and no one said this business is easy. Any of those other services that you might listen to are, so this is easy stuff. It's not. This is hard stuff, and the biggest money is made during the hardest times, both on the long and short side. Because when the market is ripping higher, and you're missing out on almost every single move higher because you're selling on every little candle moving up during the day, thinking, oh, the market can't go higher because you're not tracking the charts, then you're just doing yourself a disfavor. So services which tell you, oh, this is the only way to do it now, it's just a bear market, it's coming, they're lying. Because they never asked you to buy down here. They never asked you to buy these tactical moves up. They never asked you to look at these overbought technicals that remained overbought. And that's another thing I'm going to show you, that we are getting quite oversold. So we are due for a bounce. Believe me when I tell you. Maybe that's the bounce I'm talking about, to the right shoulder. But those services are lying. And they're very smart. Because one of the things with me, with the Clueless Day trading service, is that I try to keep away from the fluff as much as possible. Because all I could do is just sit there and tell every single trade that went up 120, 130, 200, 300%, and just keep on posting that all over my website. But I don't do that. I don't intend to do that, because the reality is that we have a lot of large winners overall, and we have some losers. But in general, we have a heck of a lot more winners than losers. But the point is, it's not easy. So if you want the easy ride, then you got to buy these tactical bottoms, holding your nose, not sleeping at night, because those are the biggest money ever made. Okay? So that's you know, how do I put this? The easiest things in life come after the hardest decisions you'll ever make. And those hardest decisions are what your brain will tell you not to do, and you have to do based on the robotic technical charts and patterns that I show. End of story. So, looking at the daily chart here, one of the key things that I do want to focus on, I'm giving you the other side of the picture, is that we are rapidly getting oversold. And it looks like we are going to do one of these. Now, if we get back into that zero territory below the 20 RSI, okay, on the stochastics, the stochastics are nothing but the derivative of the relative strength index, then given the formation here, that's when I'm looking at this engagement with this level here. You will get the inevitable bounce of this level. Mark my words, I've been right every single time when it comes to these type of patterns. and I am not going to be wrong this time, make hay out of this move that will come, because that move will be from 2030 maybe on the S&P 500, or 2020, sorry, all the way up to retest the channel, and that'll be 200-300 points higher, and I can assure you, you don't want to miss that. But in the meantime, you want to monitor this channel. We could do this. We could very well basically be oversold by tomorrow or the day after, to be honest with you, and then the bounce will come a lot quicker. It doesn't necessarily have to get down into the zero territory on the fast stochastics, right? On the zero zone. It can do this. This was the double bottom, right? When we hit the 1800? Well, it was a higher low and a positive divergence. I talked about it at that time. So it's possible that this one can basically hold the let me show you. It can hold this level here, right? Or slip a little bit below and then make a sharp turn. And believe me, there's enough global factors out there, including the fact that Japan might intervene heavy in the currency markets to prop up their yen, which I believe is coming, which can cause the market to go up 3, 4, 500 points after a terrible day, and it'll happen fast. So stay tuned, because without my alerts and my charts and my comments, you will not be there to catch that. All right? Just letting you know. So that's another possibility, that we basically base here and move hard. Or we get down here, which should be fantastic buying opportunity in the negative 0.75 range or so, or let's say in the 1 range on the stows, on the fast stows on Thinkorswim, because other charts are showing that we're not there yet. Okay, so we're getting there. So that's it. Now, again, I repeat, the best ways to play this is to play the overall market in the form of indices. Forget Google, forget Tesla and stuff. They could be news driven and not even go up on a good day in the market. We've seen that before, right? So the SPX SPYs RUTIWM. Let's take a look at a couple of major indicators. Let me actually quickly show you the futures on the Russell 2000, which has delivered some significant returns since I called the bottom. However, started acting on it more around the 1,000 range, and look where we are. Okay, now here's a couple of interesting things happening here. We are retesting this downtrend line, and which is standard procedure. And if this downtrend line holds and it gets back into this rising wedge, okay, diagonal, whatever people call it, then you should expect to see 1160 fast. The Russell 2000 calls and puts move really fast. And this one is getting there again and looking quite oversold and could very well bounce from here. So I gave you the bearish version in the first video cast. I'm giving you the bullish version, because this type of sharp, within a matter of 2 days, type of resets into oversold territory is something that has to be respected. Now, if we break, then we're going to come down to 1110 and 1092. All right, just keep that in mind. So still constructive, still on an uptrend. These are corrective formations that we're going through. We have to monitor these 34 and the 50-day lines in order to determine if the trend is still intact. However, this is showing on the daily that it's getting oversold, and a little bit more. I'll be a heavy-duty buyer of that to play it for maybe 24 hours, 48 hours, depending on the market's gives. Now, one of the reasons, let's look at oil. Very, very important. I called the shot on oil all the way from 26. Okay, it's all documented. People can see it. So let's actually keep it a larger perspective so we can see this. Oil, in my opinion, needs a rest. Okay, and it needs a rest for a simple reason. It's moved up real fast. Okay, and look what's happening here. And this could be one of the reasons why the market pulls back and does its things that I'm saying. So here you have a double top. You have a double top. It's right there. Yes, it can stretch out a little bit more, but double tops always reset lower. That's not rocket science. So if you got a double top here on the stows, how about a reset down to this level? No one's saying down here. because I think oil is still going to remain strong. We're going to summer months, um, and it's come up too far and more powerful. So much money's been put in there that I don't think these countries are going to backtrack. Okay, so let's say we have a reset down to 60 on the stoves. So where does oil go? Well, let me show you. So if this thing just comes down here, so you can draw a line here. You can go like this, drawings, price level, just put a line here, right there. And say, okay, this pattern should work. Come down, test this. It's done that before. Remember, all the bars are still green. They're still buying it on the daily. So these were the channels that I'd drawn. And I'm going to go away from the weekly and go to the dailies. And on the daily, we're starting to see the same thing. I've shown this chart several times. I draw it generally from the 50 level right there. Here are the channels. So as you can see here, we're starting to break the channel. In fact, we're going to bring it down here. Bingo. So a test of the lower channel is 45. That's about 50 cents or so. But let's look to see a forward direction on what might happen. Well, you can clearly see here. You can move this line up here. It's a triple top here. So is it possible that it comes down and tests 71 on the stoves? Doesn't have to always do this dramatic fall. Okay, that's what traders and investors out there simply all the time, like, oh, it's a one-way bet. Either we're going to completely crash and burn, or no. How about range trading, which I've taught extensively and explained? We're moving within a range. So the range that oil is moving in at this point, in my opinion, oil could test $42 right there. Now, if it falls from 45 to 43, you will get a couple of hundred points down in the market, bar none. Now, this line makes a lot of sense to me for a simple reason. That was also the breakout level that I extensively talk about in all my charts, both on the markets and stocks and such. Breakout levels tend to get tested. So right there is your breakout level, 42, 43. The other reason, which is quite simple, and people who have taken my coaching sessions and stuff understand that well, is the standard deviation from the rising 50 and the 34. The key word rising 50 and the 34-day moving average, which is very positive, mind you. Very positive. But the distance traveled away, these are the highways that the car needs to sort of drive on. It doesn't need to be sticking to it, but the distance traveled here is a standard deviation of more than 2. So what does that mean? That means there's going to be a reset. That reset could be stopped on a powerful market at 45, which is the bottom end of this channel, or it can come down and test the breakout level here, which broke out on the 20th of April. See that candle? 20th of April. Despite the fact they didn't have a deal in Doha. So if we test 42, then the distance here is probably half a standard deviation, 0.5. But here it's quite large. So I think a little pullback is healthy. And it's also profit taking. But in the meantime, as you can see here, the channels are intact. So till it breaks this level here at 45, I'm not going to basically go hog wild on the DRIP or the DWTI, which have generated profits of 60, 70 points, if not more, on a single day in many cases when oil was falling hard at the earlier part of the year, and also here in March. And many of you know that. So that's one reason. Now, the second reason has to do with the good old USD JPY. All right, this is your Japanese yen. This is a serious matter. Want to read up on it? Read up on it, Bottom line is, when a country's currency strengthens too fast, too quick against another global currency, which is, for example, the Japanese yen strengthening. Remember, this is an inverse correlation with the dollar, right? So US dollar, Japanese yen. I have a hard time explaining this to people. I don't know why. Because they're like, oh, well, if it's going lower, that means it's getting weaker. No, if it's going lower means you're buying less Japanese yen versus $1 US. So that means it's getting stronger. It's an inverse ratio of a US dollar Japanese yen spot. All right. So this is not a good looking chart. Now, saying all that, this is a monthly chart, and look what's going on with the internals. What the chart might say might not always be what the internals are saying. What the internals are saying is it's bottoming. This is a monthly chart, not a daily chart. So a novice can look at this and say, "Oh, it's looking terrible. It's going to go all the way down." No, it is getting deep oversold. And in my opinion, the rising 50, this is the rising 50 day, okay? The rising 50-day moving average at 103, 104 is going to cap it. If we break that, expect a 1,000 plus point drop in the stock markets, because at that point, the Japanese yen will break the hardcore critical barrier of 100. That means for one US dollar, you will only buy 100 yen. Now, why is that bad? Why does strong currencies bad? Because strong currency means Japan being an exporting nation. That's pretty much what they are. Their goods will be priced significantly higher because of the stronger yen. It's as simple as that. And it's very bad for their export oriented economy. Japan will, at that point, will almost be at the brink of a recession. But do you think the central bankers in Japan will let that happen? No. They will come in really hard as we are speaking. Intervention, not intervention with because somebody's teenage kid is meth addicted and all that garbage. Remember the show Intervention? Whatever. Intervention in the currency markets to prop up the yen higher versus the US dollar. In other words, weaken the yen. In my opinion, that is in the works. They're saying it. But in the meantime, the natural market pressures, not natural, these are hardcore institutional short sellers who are doing this too. By the way, they're hitting it hard. It is very possible on the worst case scenario that we come below the 50-day moving average at around this level and have a significant bounce. Look at that, like that. In the meantime, the 50 should hold, or we should actually bounce from around here. Any bounce that you see on the Japanese yen, in other words, the yen weakening or this number going higher, all right? Any weakening of the Japanese yen, not strengthening. Remember, as it falls versus the US dollar, it's strengthening. As it rises versus the US dollar, that's weakening. This number I'm talking about. So if this number moves up to 107, 108, and I showed this chart at 109 at one point, I said below 109, things are going to get hairy. The bottom line is that that's when the global markets shake. In the meantime, the U.S. markets seem to be holding out pretty well in the face of this type of this yen debacle that's taking place in the currency markets. But at one point, it starts to have a domino effect. That's all I gotta say. So these are the two main reasons we're looking at. The U.S. overall is skimming through fine. The Fed's conciliatory with rates and stuff. Our numbers. One number that I didn't like overall with the consumer confidence numbers coming out, as I've explained several times in my advanced coaching sessions, as well as the video cast that I put out there, that consumer confidence, as you know, is 70 to 80% of the U.S. economy. You start to see a weakening in that, that's no bueno, okay? That's not good. And that the markets will not like if you start to see retail sales and consumer confidence starting to come down. So, ladies and gentlemen, those are the three major factors that are the biggest risk to the market. In the meantime, we are going to make a lot of money, and long or short. In this case, let's the tactical retracement play out. I think we're reaching a point where we get a sizable bounce, which, in my opinion, is shortable. I remain optimistic on the global economy and the US markets, but I believe that tactical retracements are necessary to cut out the froth. Thank you for listening and have a great evening. And please, we need referrals for our service. God bless you all.